All right, so I'm going to ask our panelists now to come up. Peter and Brad. Peter's a genius just because he could sell his website name for more money than I think I could make in about 4 years. Condo Vultures, what a genius. Maybe he'll tell us how he did it.
Thank you. Good morning, everyone. My name is Peter Zaluskin. I'm the founder of that great name, CondoVultures.com. I thought of it on a Saturday morning in June of '05 when all the cranes were in the sky. I said, there's got to be a way to make money if this thing crashes. And I thought at the time the best way to do it was to try to corral the buyer, which was effectively the golden goose. Everybody was going to be looking at unloaded, dumb product. So if you could somehow find a way to bring a buyer in, chances are you were going to put yourself in a good situation. And what I realized, anybody who doesn't know a little bit about my background, I was a financial journalist for 12 years. I got paid basically to go out, collect, analyze, and communicate information. What I realized is, unlike commercial, we're going to hear some great information about, unlike commercial, residential was really not studied the same way. It wasn't studied on a Wall Street style or Wall Street-esque type of perspective. So what we did is, much like what Brad's organization does, we hit certain neighborhoods, we hit certain boundaries, we drove them block by block by block. Once we identified condominium projects or multifamily, we would then go in and evaluate, analyze it, pull public documents, and extract information on an apples-to-apples basis, irregardless if a condo was built in '63 or built in 2007. We put it all together into big databases, and now we've basically tried to quantify various markets. We've quantified greater downtown Miami, we've quantified South Beach, we've quantified Sunny Isles. We're in the process of rolling out Fort Lauderdale, West Palm, Boca Raton, and then ultimate Hollywood, Hallandale. And our real focus is that second home buyer and or investor. Family of four we'd be happy to work with, but that's not really our forte. The tax credit is factored in a little bit to what we do, but for the most part, our people are all cash. They're closing in 10 days. They don't care about the granite. They don't care about the carpeting, regardless of what the color is. If the numbers are right, they're going to pull the trigger, and they're going to be very aggressive on their transactions. So all the information Brad's pointing to is the same information we're seeing. The market's starting to turn, which is great for the economy. It's terrible for what I do. Sort of give you some perspective, it's anecdotal. I'm going out to Las Vegas next month to go and look at leasing an apartment, because the reality is a lot of the big bulk stuff, which is primarily where I focus my time on, the rock star product, if you will. And how do I define rock star? Fund manager flies into Miami International Airport, he gets into a cab, or she gets into a cab, they head over to the Four Seasons, they head over to the Icon, or they head over to South Beach. Whatever they see during the course of that trip, that's rockstar. Anything else that they're not going to find on their own is primarily the B grade product. Most of the A is gone for the most part. What's not gone has been spoken for in a big way on a bulk basis. And it's not gone because of bulk buyers. It's gone because of individual buyers. The individuals who are moving in, whether for wealth preservation, whether a currency play. The Canadian loonie is dollar 1-to-1. So you're seeing a lot of movement, a lot of transactions, but most of it's being done, I would make the case, by foreign nationals. The number may be 30% in Florida in terms of foreign nationals. I would make the case that's probably closer to 60 to 70% in the condo market, especially if it's new product, because there's no financing. Financing does not exist. Fannie Mae has a special ops team, I call it, 6 people to come down here and approve every single building. You can imagine for Fannie Mae Fannie Mae financing, but lo and behold, no lender is going to originate the mortgage. That's what we're finding. So the second step is there, but the first step doesn't exist. It's not being originated. So lo and behold, most developers are being forced to go all cash. So the market's changing. Let me hit you with a lot of real quick data, just give you little increments, and then I'll turn it over to Jack. On the foreclosure side, first quarter filings, these are list pendants. This is the initial step. Normally after someone's 90 days late on a payment, bank will move forward and file that list pendants filing. We're seeing a 21% drop in the first quarter of 2010. We would be on pace this year if it continues to do about 80,000 foreclosure filings, compared to 97,000 in '09, compared to 76,000 in '08, and 33,000 in '07. REOs, bank-owned properties, once the bank actually takes possession as of the court, we saw a 25% spike in that in the first quarter. The reason that is that there's a lag time from the time the foreclosure is filed, the initial list pendants, to the time it actually ends up in the bank's hands. Bankers have told us back in the day in '07 when it all first began, it was about a 6 to 9 month process, typically about a $40,000 expense. Could be as much as 80. That's a loss of debt service, attorney's fees, court fees, damage, so on and so forth. That has now spiked because of the strategic defaults, because of other issues, to now roughly about an 18-month period and about $100,000. So what many of the lenders are finally deciding to do is, rather than go and foreclose out a property, take 18 months, cost them $100,000, increasingly they're going towards the short sale. So that short sale, it's much easier, and at the end of the day, the short sale is going to trade at the same price, generally speaking, as a bank owned. So watch for that transition over. We would make the, it's our guesstimate. Foreclosures are going to continue to tail off. At least the filings, you'll see more modifications, you'll see more short sales from what we're seeing. In terms of available inventory, really quickly, we use the multiple listing service. It's effectively a large trading pit to try to get a sense of what's going on. These are all resales. We track single family, condo, townhouse. November of '08 is when I first started doing this. 108,000 properties for sale at that time as of Monday. And I do this every Monday because typically the transactions that occur or properties that are listed over the weekend, they're updated on Monday. And the MLS doesn't give you any kind of historical aspect. 108,000 November of '08, 66,000 available today. On the condo side, particularly 60,000, 61,000 condos available '08, 40,000 available today on a resale basis. Pending sales back in November of '08, all product, tri-county wide, 9,200 pending sales, contracts in place, today 22,000. So you're seeing a significant transition that's starting to occur. In terms of downtown Miami, that's really what we came here to talk about. We're averaging about 220 transactions per month for the last year. Since July of '08, when the first bulk deal went down, there's been about 5,100 units that have traded. These are all cash. Of those 5,100 that have traded, only 1,000 have gone to bulk buyers. The other 4,000 are primarily gone to individual investors. And I would tell you, these are not necessarily all new investors. Many of them are people who had 20% deposit down for 3 or 4 or 5 years. Now they're being forced to close because the developers come back to them. They've offered them a nice discount. People are moving forward and pulling the trigger. Now, one other interesting point before I give it to Jack. In the first quarter of 2010 in downtown Miami, we saw about 720 transactions occur. Greater downtown Miami. This is the Rickenbacker north to the Julia Tuttle, I-95 east to Biscayne Bay. About 720. We looked at the first quarter, and we just came out with a report on Monday. First quarter in South Beach, and many people say, well, there's nothing left. Well, there's actually 25% of that overall inventory is still available, new product. They moved 17 units. 17 units in South Beach, 720 in downtown. The question is why? Out there in South Beach, they averaged over 1,300 a foot. You come into downtown Miami, you're going to average about 326 a foot. So really that investor, and these are people who have no intention of living in this stuff, they're all going to rent it. And from a rental perspective, we're seeing about 330 leases per month occurring since August at a median lease price of about $156 a foot. Your expense on that is probably going to be about 80 to 85 cents a foot. So it's a little bit positive. It doesn't cover debt service, but for many of these investors who are parking cash, they're saying we're a little bit positive, we're optimistic that we're buying at replacement cost or below, and when the market starts to turn, financing starts to become restored, we think there will be a demographic transition or a shift away from South Beach, not around the rim, the nice high-priced celebrity condos, but more so the Art Deco product. You're seeing a lot of those people who are living in the Art Decos parking on the street with the wall units, 1950s, 1940s, 60s product. They're all moving to the downtown because it's simply better value. You're seeing them come from Kendall. You're seeing them come from other more mature, antiquated markets. So, I would make the case that the Downtown Development Authority is going to have a lot of fun going forward, but I would not want to be Kendall. I would not want to be the inner core of South Beach. I wouldn't want to be the Aventura. These people are basically going after the value. The value right now, because of the inventory that exists in downtown Miami and is being acquired, is basically where most people are heading.